Well, welcome everyone to Getting Started with Options. This is week 2 in our series. Today we are going to talk about buying long calls. And what a great day to talk about this strategy because, the market is up pretty dramatically today, isn't it? And buying a call, which in trader speak we call a long call, is a way that we can take advantage of a stock or an index that is moving up. And so that's going to be our focus for today. I want to welcome all of you who have been regulars here for a long time, and also those of you who are maybe finding us for the very first time. So if you're joining us for the very first time today, if you would like to type a greeting into the chat, we would love to welcome you. And so hello to John, the Noble Savage. Some of your handles are fantastic. And Kevin and Debbie and AP514 and Life in the Fast Lane and Michelle and Jeff and Kim and Chena and Clicktician and David and the rest of the gang. Thank you all for being here. If you are brand new, I'd like to welcome you and encourage you to put this on your calendar on a weekly basis. We meet at high noon every Tuesday to link arms together and figure out this stuff about options. And one of the things that I found very empowering about options was that it's like you have this kit bag full of really powerful tools, and there are some tools that work really well when a stock is going down in value, some tools that work really well when a stock is going sideways, and then there are tools like the tool we're talking about today, a long call, which work beautifully when a stock is going up. Yeah, somebody's saying, woohoo, long calls are my jam. So Erica, you're in luck because that's our topic for today. So let's just get right down to business because we do have a lot to cover. Also know right on this cover page, it says that, I'm on X, formerly known as Twitter, and I am posting content there on a regular basis. And, you're going to want to follow me so that you can get kind of the latest and breaking news. My handle at Barb Armstrong, CS for Charles Schwab. And, one of the things that I've done in the last couple of days is I've recorded a couple of mini sessions, one on how to set up a chart on thinkorswim, another one on how to use watch lists. I'm going to do a third on the monitor tab. And these are all kind of under the 10-minute mark. And I will post a link to those on X as soon as they're available. They'll also be available in a playlist. So stay tuned for those. Okay, so just know that everything that we do in this class is for education and information purposes only, none of it to be construed as a recommendation on the part of TD Ameritrade or myself. Know that options carry a high level of risk and aren't suitable for all investors. Certain requirements must be made to trade options through Schwab. So when you open an account, in your paperMoney account, you can trade absolutely anything. But in your live account, in order to trade options, you have to apply for that, and not all will qualify. With a long option, so if we buy a call, how much could we lose? All of it. We could lose all of it. So we have to be aware of that. And that's where having a set of rules around trading and position sizing is really important. Know that all investing involves risk including the loss of principal. So what are we going to talk about today? Well, we are going to talk about the basics of buying calls. Like, what does it even mean when I buy a call? What am I getting myself into? We're going to look at why some traders might find this to be an appealing strategy. We're going to look at some things that we want to be sure we consider. And then we're going to place an example trade and then look at, what you might want to do next. Yeah. Okay, so that's what's on the menu for today. So let's start with that first line, which is, what does it mean to buy a call? And, so it's important that we understand this. So when we buy a call, it gives us the right, but not the obligation. Okay, so to buy the stock at the strike price at any time up until the expiration. And in most cases, one option represents 100 shares of stock. So, and I had to draw this out. So if we see a stock that's going up and maybe it's pulled back and it's gone up again, and then it's pulled back for a few days and it's starting to go up, we might say, you know what? I think this stock is going to continue to go up. And right now it's trading at maybe $49. I am going to buy a call right here at 50. And maybe I paid $2 for that, okay, which is $200 a contract. So now what do I have? I've got the right to buy this stock at $50 at any time up until expiration. So if it goes according to plan, and my plan is that the stock continues to go up, let's just make the math easy for me. If it continues to go up, say to $60, what would this call be worth? Well, I have the right to go out and buy it at 50. I could turn around and sell it for 60. So this call has got to be worth at least $10, and it might be worth a little bit more because there might be some time value in there as well. And so if you look at that, you could say, well, if that happened, how much would I make? Well, if I just buy the call, I have two options or two choices. I can either just sell the option for $10 and then I've made $8 a share or $800, and that's like a 400% return. So, I mean, there is dancing in the streets, there is champagne being opened, and you're thinking, where have options been all my life? Yeah, it's a celebration. The other thing that some could do is you have the right to exercise your right to buy shares at 50 and then sell them at 60. And how much would you make if you did that? Well, you'd make $1,000 minus the $200 that you paid to get in. And so, some people, if they have a smaller account, they might say, Barb, I couldn't buy the shares at $50 a share. I only have a $3,000 account or a $4,000 account, or, if I did this and I had a $10,000 account, that would be half my account. But you don't have to exercise your right. You can just, some traders, their goal is just to buy a call and the goal is to sell it for more. Now, what happens if you're not correct? Or if tomorrow some news comes out and the market in general starts pulling back? Well, if it goes down below 50, especially as you get closer to expiration, it doesn't have to go all the way to 40. It could be at 48. Well, if I have this gives me the right to buy the stock at 50. Who's going to want to buy this if the stock is trading lower than that? Because, they could just go out and buy it for less. And so this is going to decrease in value, become worth less, and ultimately it could become worthless. And that would be, not the 800% gain that I'm drawing here, which isn't necessarily all that common, but is possible. This would be 100% loss. Now, do we position size for 100% loss? Yes. Do we put a plan in place with the expectation of getting out before we've lost all of it? Absolutely. But this can happen. Okay, so should this long call, which is buying a call, so long means buy, if we have bought this call, if it expires worthless, that's that 100% loss. Now, potentially, the maximum potential reward is unlimited, but often we will put a target in place. So we will cap our gain ourselves. And why would we do that? Because we'd like a little win. Because, we don't want to see stocks go up like we saw through the first part of this year. And then for the last 3 months, they were pulling back in August, September, and October. And now we're moving up again. So when we look at what we're looking for a stock that is moving up, which is bullish. And we're trying to benefit from an upward movement in the stock's price. Now, one of the things about a call, and let me just draw this again, is that if it starts to go sideways, time value will be nipping at our heels. And so this isn't necessarily a good thing. We want this to happen. Okay. So are there any questions? Okay. Guess I did a good job. Let's go to the next one. I am a huge fan of trading plans. And I think you should have a recipe or a trading plan for every single strategy that you trade. And, it just helps take the emotion out of trading. And I'm also a big fan of knowing when you're getting out of a trade before you get in. And you might say, well, what do you even mean by that? Like if it keeps going up, I want to stay in. Well, how do you define stop going up? If you're going to get out, if it stops going up, how do you measure that? Okay. So if we look at this, let's talk about our trading plan here. And there are 4 components to a trading plan. So what to buy, when to buy, how much to buy, and then when to exit the position, whether the trade goes for you or against you. And so this part here is our what to buy. And then this part is our when to buy a call. And so we want a stock that is bullish or uptrending. For higher trading volumes, how do we define that? Well, this is just an example. You can make it whatever you want, but you might say, I want it to be 1 million shares a day or more. And you want the options to have high trading volume. That's why you care about the stocks. You might say, I'm trading an option, not a stock. But if you have high trading volume on the stock, you're more likely to have high trading volume on the option. So we might say here, well, I want at least 20 times the number of contracts on the strike I'm looking at as I'm thinking of trading. Okay. If I have an option, I'm also looking for options that have a tight bid-ask spread. So there's someone called the market maker, and he matches up the buyers and the sellers, and he doesn't do that for free. He gets paid the difference between the bid and the ask. And so we want that to be small because that takes away from our profit or it adds to our loss. And so as a rule of thumb, we could say we want it to be under 10%. And that's just a guideline. Again, you can make that whatever you want. And then we're looking for what we call a technical breakout. And if you're not familiar with looking at charts, I've posted some stuff on Twitter in the last week that you might want to go look at, but there's a class called Getting Started with Technical Analysis, which is what looking at the charts is all about. So you may want to check that out. So we're looking for a stock that's breaking above resistance, bouncing off support, or something like this pattern here, where it starts to go up again. When it goes up above the high of the low day, we call that a hold or a close above the high of the low day. And so what does that look like? Well, I'm glad you asked. Now, someone's asking if these slides are available, and they are not, but this will be archived and you can go back and watch it as many times as you like. And take copious notes if need be. So here's what that hold looks like. So something's been pulling down and then starts to move to the upside. And here we have a close above the high of the low day. These patterns that I've been drawing, this idea here, it goes up, pulls back for a few days. Then it starts to go up again. And again, here, that would be another close above the high of the low day. And then here, it consolidated for a bit. We see this happen frequently. And when it breaks through this ceiling or resistance level, that also could be considered an entry. All right, so this is the kind of setup that we are looking for. Let's go out to the charts. And for me, this is where things really come to life. And if any of you are brand new, I was saying before the class started, I very much When I was learning, I had two screens. So I had my laptop and a desktop. I didn't have a monitor at that time, but I would bring this webcast up on one. And then whatever the coach was doing, I tried to imitate. If they drew a line, I tried to draw that line. And in the beginning, it was frustrating because I didn't know how to do anything. But and one of the nice things about watching the archives is you can back it up, play it again, back it up, play it again. And if you're thinking as you're watching this, like, oh, I need to see that again, just jot down the time. And then you'll know where you want to go in the recording to watch that little bit again. So we're going to look at Nike. And, Nike is down 9% year to date. Which is, it's really been on the struggle bus. But it hit this low here on earnings back at the end of September, or the day before earnings, and then it's gapped up, and it really hasn't looked back. It's been moving to the upside. And so do you see this pattern that I was drawing earlier? Sorry, I didn't mean to bring up that pattern, but this idea of came up, pulled back. Came up, pulled back, came up, pulled back. And it's, what do we have here? Close. At least it's trading above the high of the low day. Now with options, keep in mind when we buy a call, we could just buy a call and see how far it goes. Or we could say, you know what? One of the advantages I have of being a small trader, which means you're not buying with millions of dollars as an institutional trainer, is that I can come in and make a little bit and say, thank you, and then do it again and do it again. And so here was the previous high up here around 110. So could we buy a call and say, hey, it's trading at 106.33. When it gets to 110, I'd like to sell it. And how much might I make? Well, let's go and look. So we're going to come to the trade tab. And here's our option chain. And we are going to come out, if we think, well, this, move here took 1, 2, 3, 4, 5, 6, 7, 8 trading days. We want to be out of this trade 20 days or so prior to expiration. So if we have 30 days, do we think this might make its move in about 10 days? That's our expectation. Now, sometimes expectations are met and sometimes they aren't. But if we're following our set of rules, our rules say, does it trade 1 million shares a day or more? Check. If we're looking at this, we can either look at the first strike in the money, which is this one here at 105 because it's already trading at 106, or the at the money strike. So the first strike above where it's trading. So if we did this 110, open interest tells us how many contracts were on the books when the market opened today, over 5,000. Well, we have a small account here. It has $21,700 in it. And our guideline is we don't want to risk more than $400 to $500 on any one trade. And so what is one contract going to cost us? $1.30. Now, our third thing was, is the bid-ask spread tight? And we wanted that to be under 10%. It's 2 cents, and it could be as long as it's less than 13. So we're check, check, check. And then, so it's what to buy, when to buy, how much to buy. So our how much is, if we lost the whole thing, how much would we be out? Well, $130-ish. If this fills at this price. So, how many contracts could we do? Well, if we're willing to risk up to $500, we could do 3. Okay. So we're going to click anywhere on this line. And we're going to buy custom with an OCO bracket. What does that mean? It means we're going to put in both a target and an exit. So then the fourth thing is, when do we get out? So what to buy, when to buy, how much to buy, and when to exit. And the when to exit has two pieces. Excuse me. The first one is if it hits our target, if you have a target, or if it hits our exit. So we're going to put in both a target and an exit. And our target is going to be based on the price of the stock. So we're going to make this a market order that's good till canceled. And we're going to come in, and beside best, there's a little reappearing, disappearing, reappearing sprocket. And we're going to say, if and when Nike goes above 110, I'd like to sell this call for whatever it's worth at that time. And we don't know what it's worth. Volatility may change, which would make the price higher, the value of it higher. We might not get out on the day we're expecting. So we're just saying, if and when it hits 110, we want to exit. And if we lose, if it goes down in value by 50%, we'd like to exit. So I'm going to take $1.35 and divide that by 2. So if this gets to the point where it's worth about 67 cents, we want to exit. Oh, I've got 2 periods in there. That won't work. Okay, so I'm going to come to confirm and send. And we want to buy a call because we're bullish, check. We want to sell that call when it gets to 110. And if it goes the other way, the trade goes against us, we want to sell it if it loses half its value. Now, how much are we risking here? $405. Is that acceptable? Our guideline is we don't want to go over 500. So yes. And then we're going to put this in our long call group. And we're going to put a note in here that is just for us to see that this is a swing target. So we're just going to trade it up to the previous high. Now, are there any questions on that? My question would be, well, if it goes up and hits my target, how much can I make? Well, I like that question. So if we come here, and I'm just going to, I know it's the obvious, but I saw this and I was so wowed by it. And then I couldn't remember where I saw it. So you're on the trade tab. Sorry, just one sec here. Okay, sorry, I just had to deal with a little something. So we're on the trade tab. And we're going to come down to layout and we're going to choose Theo Price. And then it's going to bring up this additional menu and it's going to bring a new category here. It won't be open interest. Okay, so just so you know, because I ended up having to call the trade desk. And guys, you know what? If you aren't sure about something on thinkorswim, the trade desk, those guys are so helpful. They can share a screen with you and walk you through things. So never be afraid to use that as a resource. But yeah, so we're going to come to layout. We're going to come to Theo Price. And then the first thing I always do is hit reset. And then I'm going to look at this and say, okay, it's at 106, call it 106.50. If it goes up by 350, it'll hit the target. So I want to add $3.55 and hit enter. Now I'm not going to change volatility or anything. I am going to change the date. And let's say this goes up and hits our target by Friday. Now it might not, it might be another week. The expiration date is December 15th, which gives us 31 days to expiration. So if we look at this and we now see, we now see that we have another column. We have another column here, this Theo Price column. And what it's saying is we paid around $1.30 for this. it would be worth about 268. And you know, my math skills aren't necessarily the best on the planet, but they're making it easy. That would be 100% return. Now, keep in mind, we have a stop in place to say we want to exit if this loses half its value. But if it were to gap down, we could lose the entire amount. It's not a guarantee that we'll get out at that price. Yeah. Now, Ken, what I'd suggest you do, it's what to buy, when to buy, how much to buy, and when to exit. You know, if you go back and watch this in the archives, I go through all of that. You know, you can just kind of take some notes rather than going back through it all again. All right. So that's a way to find out the price. Now, if you wanted to do another example, let's come and look at Walmart. So with Walmart, this is a stock, it's up 18% year to date. And we've seen it kind of this, some might call it a cup and handle. And this is a consolidating pattern, you know, where after, you know, a nice run up, which we had here, it kind of catches its breath. And sometimes it'll just go sideways, but here it pulled back as the market was pulling back. And then we had this, you know, little jog. So here's our cup, here's our handle. And then yesterday it broke out, and today it's hitting a new, at least a 6-month high. It might even be a 1-year high. So if we were thinking this might continue to go up, could we buy a call on this? And if we wanted to put a target on that, what might that be? Because, you know, it has nothing to swing up to, right? It's breaking out to a new high. And so with that, we could come down here and look at ATR. And what does ATR mean? It means average true range, which is what it stands for. The 14 means this is showing us that over the last 14 days, in an average day, Walmart has traded in a range where it's moved from the high to the low of the day of about $2.04. And so could we just look at this and say, hey, if this goes up another $2.04, I'd like to exit. And so that would be a pretty short-term target. And with this strategy, we tend to be in it for just a few days. Okay. So let's look at how that might, you know, how would we put that one in? And so if we look at what our target would be, if we come here, our high today is 169.15. And if we add $2.04 to that, that would be 171.19 would be our target. Earnings. I don't see earnings showing up on my chart. Yeah, because typically we don't do this right prior to earnings. Let me come over here. Now, you know what? I'm just going to go ahead and put this in for example purposes. But if earnings is the 16th, some people might choose not to take this trade. And why would they do that? Well, because often what happens is your volatility is higher coming up on earnings. We're going to come back here to our basic. So, you know, volatility is typically higher. You'll see here, you know, this one expiring Friday is at 43%, which would be because of earnings. But out here, it's at like 20%. And again, does it trade more than 1 million shares a day? Okay, so the earnings is the 16th. You know what? I'm going to pick another example then. So thanks, guys, for pointing that out. How about Visa? Okay, so Visa, we just had earnings, so we don't have earnings in the way. And, you know, here we have a double bottom pattern. You know, I always think of that song by Queen. Now, some people, if they're doing a short-term strategy like that, one of their rules is they won't trade it, you know, if it's the week of earnings. Okay. So I love that you guys are so on top of things here in the chat. And I don't know why that isn't showing up on my chart. So I'll have to figure that out. But this is another kind of consolidating pattern after a run to the upside. And this one too, up 18% year to date, came up to 250. Then it kind of came back. And this double bottom pattern, it broke out, came back to retest, which is pretty common, and is again moving to the upside. And so could we do this same kind of thing here? You know, and our ATR on this is at 335. Now, if you don't have that on your chart, let me show you how to add it. So let me just wipe the slate clean. We're going to come to studies, edit studies, and then you're just going to type in ATR. Okay. Oops. I didn't want it. So I'm just going to highlight it and then add selected, and you'll see it appears here. You hit apply and OK. Now I actually already have that on my chart, so I don't need a second one. Also, there's a little question mark beside it. So if you want a more detailed definition of what average true range is, you can read here. That's kind of handy. There's a lot here on thinkorswim. You don't need to use, you know, certainly all of it. I use a fraction of it and I'm a coach, but it's nice to have that definition handy. So if we look at this and we say, okay, well, today's high is 247.88. And so let's come over here and I am going to bring up a scratch pad. Now, we did a similar example yesterday in our long, I teach a class that's just dedicated to long calls and long puts. And so we did an example yesterday. And so here's our example for today. Visa 1 ATR. And our 1 ATR is 335. And so our target is going to be today's high, which is, just write these down. The high is 247.88 and the low is 245.58. So our target is going to be 247.88 plus 335. And I've got a little calculator right here. So 247.88 plus 335, 251.23. And then, whoops. And then our exit will be 245.58, which is today's low, minus 335. So if it goes down, you know, it's not going in the right direction. And so we want to try and limit our losses. So 245.58 minus 335, 242.23. How do we put that in? Well, we can put it in the same way. So we can come out here and again, does it trade more than 1 million shares a day? Check. Do we have lots of open interest? Thousands of contracts? Check. Is the bid-ask spread tight? Well, this is basically a $3 option, 4-cent bid-ask spread. So check, check, check. So it's trading at 246. And again, you know, we don't want to spend more than $500 because we could lose the entire amount. So we're going to do this at the money strike, the 250 option. And we are going to buy, and we can do this as buy with an OCO bracket and put it in this way. Or we can come up here and just say buy. And I'm just going to show you another way to accomplish the same thing. We're going to come down to this bottom corner and click single order. first trigger sequence. We're going to right click anywhere on this line and create an opposite order. Okay. So when we do that, I'm going to make that good till canceled. I'm going to make it a market order because we're going to get out based on the price of the stock. And then when I click that disappearing, reappearing sprocket, I can put in both my target and my exit at the same time. So if, as anticipated, Visa goes above 251.23, I always like to use positive language, 251.23, it's hit our target and we want to exit. Or if we are mistaken and it goes down 242.23, we're going to take what's left of our option premium and live to trade another day. And if you scroll down to the bottom, you're going to see, okay, greater than 251.23, check, or less than 242.23, check. So we have both a target. We're going to get out either when it hits our target or if it hits our exit. Now, what if it comes up to 251.03 and then it looks like it's going to maybe roll over and pull back? Well, there's nothing to say you can't go in and say, hey, I'm going to take this profit. I don't want to snatch defeat from the jaws of victory. And I have seen many times something come up to within like 15 cents of our target and then turn around. And so this is something you're going to monitor daily. And when we look at Visa, again, above 251.23 or below 242.23, it's saying our max profit is infinite, but we're saying, hey, if it goes up a little bit, we want out. Base hit, earn a little. How much could we lose? We could lose this entire amount. And you might say, but we have a stop in place. And we do, but what if it gapped down? So we're position sizing, preparing for the worst, but anticipating the best. Okay. So we're going to put that in our long call group and then and we're going to just put a note that we have a 1 ATR target and exit. You may say, well, these notes, like once I put the order in, how do I see them? Well, I like your question. Let's go look. So if I come here to the monitor tab, you can see here that these orders were filled. And if I click on this little note here, it'll tell me. I also, if I'm looking at working orders, I've got all these little notes here. So if I click on this, it will tell me. Okay. So that kind of makes it easier. Now, what do I do day to day with these? Well, you're going to have a look at these tomorrow. So we placed 2 long call trades. Actually, we did 3 long call trades yesterday. We already hit our target on one of them. And it was one of those 1 ATR trades, I think. Let's look. No, it was a swing trade on Micron. So let's go look at Micron, just so you can see the other side of the equation. So here we go. So here was our swing target at 76. So we probably got out right at the beginning of the day. Now, how can we figure out how much money we made? Well, we're going to come to the monitor tab. It's just serendipitous that this worked out this way. We're going to go back. We only need to go back like 2 days. I'm going to put in 4. And we're going to come to Micron. And yesterday we placed 2 trades, and we did one with a longer term target and one with a shorter term target. The shorter term target, we had an expiration date of December. And you can see here that we paid how much for that? We paid $275, and we did 2 contracts. And they hit our target this morning right as the market opened, and we got out for $365. Okay. Now, so how much did we make? If I just subtract one from the other, That looks like 90 cents to me, or $90 a contract. How much, if you're saying, well, what was our return on our risk? Well, how much could we have lost? We could have lost $2.75 per contract. How much did we make? Well, we made 90 cents. And so we're going to divide that by 275. So 90 divided by 275, that's a 32.7% return on our risk for a trade that we were in for one day. And that, my friends, we call a base hit. Now, if we want to see, like, had we not put that target in, because we do have, we could come back out and look at this 75 call and say, well, if we had held on a little longer, I could have made more. And you would have. But you know what? You made a 32% return, and you could have been out, walking your dog this morning, golfing, at work, skiing soon, like whatever it is that you were doing, and it hit your target and you were out. Because sometimes things will go up, and then by the end of the day, they've pulled back down. And sometimes you get out right at the tippy top. And sometimes, like today, we got out, at the beginning. Okay, and the other trade we're still in. Now, this trade that we have a higher target on, we knew we were going to be in that one a little longer, but where does it sit so far? If we come and we look at this other trade, well, we're up 28.89% on that trade. We have a target on it. It doesn't expire until January. And I drew the target on the chart. It's, here is our longer range target. And I type target in up here. And then if I say show on the right, when you look at your chart, you'll see what that target is. So we're expecting to be in this one for a little longer. Okay. But you can just at a glance, because I added profit and loss percentage, and you might say, well, that's not on my monitor tab. Well, you can customize every single group. And so if you come to this sprocket on our long call group and just type PL percentage and hit add item, there you go. Bob's your uncle. Pretty easy, isn't it? Once you know how to do it, like so many things. Now, what if you're saying like, hey, all my stuff is mismatched into one group? And I'm going to do another mini session on how to set up a monitor tab, but let's say they were all just sitting in one group. I could click on this and say move to group, and then add a group and give it a name, whatever name you want. Okay. So we've got all our long calls in one group, and then, our other trades, they're all in their own group also. All right. Well, guys, you know what? I hope that you have found this helpful. We've done 2 trades today. So we've done one on Nike, which had a swing target, one on Visa that had a 1 ATR target. I know that you guys were paying attention, because when we looked at Walmart, earnings was coming up on that one. So, we took a pass on that, and, it could have worked out super well, and it could have been an absolute bomb. But, if our guideline is that we want to avoid that short-term trade over earnings, now others might do it as an earnings trade. So there's no right or wrong. It's just what's your strategy. And so we took a more conservative approach. This is where I can get a teensy bit bossy. Don't forget to follow me on Twitter at Barb Armstrong CS. Also, we have Lee Bull with us in the chat today. He's been answering your questions. If you want to follow Lee on Twitter at Lee Bull, CS for Charles Schwab. And then there's a survey in the chat, and I'm just going to post that. And here's the deal with the survey. It's 2 questions. And, it's a 1 to 10. So 1 means I hated it and I'm never coming back. 10 means I loved it and I'm not going to miss another one. And then there's everything in between. And then you have the ability to put comments in. So if there's something that you didn't see in this class that you'd like to see in future classes, let me know. This is where you have a voice and I'm doing this for you. So, if you found the pace good, let me know that. If you'd like it to be faster or slower, it's your voice. My promise to you is that if you promise to fill it out, I promise to read each and every comment. The management team will as well. The last thing 2 more things. 1, make sure you've hit subscribe because that's the easiest way to find these webcasts and to see what's coming up next. And then hit like. And it's your chance to do a favor for a random stranger who you may never meet because it moves things up in the algorithms and in YouTube land, it just exposes these webcasts to more people. So you're helping us get the word out. Okay, so like, subscribe, survey, X. So that's a wrap. And then what do you want to do next? If you really think this strategy is appealing and might work out well, given your goals and account size, etc., you may want to join me on Mondays for the long options class at this same time. Getting started with options is a great getting started with technical analysis is a great series. So you may want to find Cameron May and join that class. And then you may just want to go back to the archives and watch this again and the first one in the series, which was last week. I have posted links to the coaching calendar and to, this Trader Talks channel in the chat, and I'll post it in the notes below. So thank you so much for joining me today. Know that I think we've covered what we set out to do, and just know that all investing involves risk, including the risk of loss, and that options aren't necessarily suitable for everyone, but we've covered what long calls are, what a trading plan might, an example trading plan might look like, some things to consider. We've done a couple of example trades and then looked at what you might want to do next. So have a great day, everyone. We'll see you in a webcast coming up soon.